Most people think building wealth in today's economy means chasing the hottest stock tip, day trading like a Wall Street pro, or having insider access to hedge fund allocations. Truth bomb. You don't need any of that. What you really need is a portfolio strategy that not only grows, but survives the storms, recessions, inflation spikes, market corrections, even climate shocks. That's where sustainable finance comes in. And no, it's not some boring eco-friendly buzzword. It's a legit way to future-proof your investments so your money works as hard tomorrow as it does today. If you've ever worried about inflation eating your savings, or if you've been tempted to pour cash into high-yield stocks without a risk strategy, this video is for you. You'll learn practical steps, mindset shifts, and smart allocation moves that you can implement right now, even if your investment account is starting at $500. If you're ready to unlock your potential and achieve more, hit subscribe. We're dedicated to delivering actionable tips and real-life success stories. All right, let's get started. Number 1. Build a defensive core with dividend-paying ETFs. Think of dividend-paying ETFs as your financial bodyguards. They might not be flashy growth stocks that make headlines, but they deliver steady cash flow through dividend income. For example, if you invest $10,000 into a high-quality dividend-paying ETF yielding 4%, that's $400 per year, paid to you without selling a single share. Reinvest those dividends through a DRIP, dividend reinvestment plan, and compounding kicks in like a snowball rolling downhill. The magic here isn't just the income, it's the resilience. During market volatility, dividend stocks historically drop less than growth stocks because companies paying dividends usually have strong cash flow and solid balance sheets. It's like building your house on rock instead of sand. If you're young, don't skip this strategy thinking dividends are only for retirees. Reinvesting those checks in your 20s or 30s can literally double your net worth by retirement. If you're older, dividend ETFs act as a built-in paycheck for your retirement portfolio, sustainable, reliable, and inflation-fighting. But here's the twist. Protecting your money isn't just about one asset. It's about where your money lives in the world. And that takes us to the next strategy. Number 2. Diversify beyond borders with global equity exposure. Here's a myth people fall for. If the US market is strong, you don't need international stocks. Wrong. Global equity exposure is non-negotiable for a future-proof portfolio. Why? Because the next wave of growth may not come from New York or Silicon Valley. It might come from emerging markets like India's tech sector or Africa's renewable energy push. Take a simple example. Let's say you put $5,000 into an S&P 500 index fund and another $5,000 into a global equity ETF that includes companies in Europe and Asia. If the US economy slows down while Asia booms, your global portfolio balances itself out. That's portfolio diversification in action. Sustainable finance isn't just about being eco-conscious. It's about making sure your money isn't hostage to one economy's ups and downs. With global ETFs, you get exposure to renewable energy, green infrastructure, and innovative companies worldwide, all while lowering your risk. Number 3. Guard your wealth with risk management. Think about this. When you drive a car, you always wear a seatbelt, right? Not because you expect an accident every day, but because when it happens, you'll be glad you had protection. Risk management in investing works the same way. Most people ignore it until it's too late. One simple rule is to never put more than 5–10% of your portfolio into any single stock. If Apple stock, or any growth stock you love, suddenly tanks 40%, you won't lose your shirt. You'll lose a sleeve at most, and sleeves are replaceable. Another trick? Set stop-loss orders. It's like telling your brokerage account, if this stock drops 15%, sell it automatically. That way you don't make emotional decisions when markets turn ugly. Remember, markets don't ask your permission before they crash. Successful investors don't just chase returns, they protect their downside. You can't control the stock market, but you can control how much damage it does to you. And if you think protecting wealth sounds boring, wait till you hear the next move, because it's about turning everyday expenses into investments without even realizing it. Number 4. Add real estate for steady cash flow. Picture this. While you're asleep, someone else is literally paying off your mortgage. That's the beauty of rental properties. Real estate isn't just about owning a fancy house. It's about creating passive income streams that keep flowing even in a bear market. You don't have to start with a $1 million condo. Some people begin with small duplexes or rental properties that cost $100,000 or less in growing areas. Rent covers the mortgage, and over time, equity builds up. In 10 years, not only has the property value likely gone up, but you've also built a steady stream of cash flow that's tax-friendly. Real estate acts like a buffer against stock market volatility. When stocks swing up and down like a roller coaster, steady rental income feels like a seat on the Ferris wheel, slow, predictable, and still moving upward. Owning assets that generate cash flow is only half the game. The real wealth hack is making your money grow automatically, even when you're not thinking about it. That's where our next strategy shines. Number 5. Automate with dollar cost averaging. If you've ever promised yourself you'd go to the gym next week but never did, you know that relying on willpower alone doesn't work. Same with investing. That's why the wealthy automate their systems. When prices are high, your 500 buys fewer shares. When prices are low, that same 500 buys more shares. Over time, the cost averages out. You don't have to time the market, you just stay consistent. It also removes the emotional roller coaster. No panic selling during crashes, no FOMO buying during rallies, just a boring, steady system that works. Here's the question. Do you want to rely on mood swings and gut feelings? Or do you want a portfolio that builds wealth while you're living your life? And speaking of living your life, the next strategy is about choosing investments that don't just make money, but also align with the world you want to live in. Number 6. Invest in ESG and sustainable funds. Here's the truth. Your money isn't neutral. Every dollar you invest is a vote for the kind of world we'll live in tomorrow. That's why ESG funds, environmental, social, and governance, are gaining steam. These funds put your capital into companies that treat workers fairly, reduce carbon emissions, and actually have long-term survival plans. If you start adding ESG ETFs into your portfolio, you're not just hedging against risks. You're creating alignment between your wealth and your values. Imagine telling your kids one day, "Yeah, we grew our retirement portfolio by backing clean energy, not oil spills." Number 7. Catch the wave of future industries. Every decade has industries that explode in value. The 2000s had tech, the 2010s had social media, the 2020s. It's all about clean energy, electric vehicles, biotech, AI, and digital infrastructure. If you're serious about future-proofing, you can't just hold on to yesterday's winners. You need exposure to tomorrow's. Does this mean you throw your entire portfolio into AI stocks? Absolutely not. Remember the dot-com bubble? Too much hype, too little substance. But having 10–15% of your portfolio tilted toward growth industries gives you a chance to ride the wave without drowning. Think of your portfolio like a house. Dividend stocks and bonds are the foundation. Real estate is the roof. And these future industries? They're the solar panels, extra power that accelerates your wealth. Number 8. Hedge against inflation. Here's a scary fact. If inflation averages 3% per year, your money loses half its purchasing power in just 24 years. That means $1,000 today will only buy you $500 worth of goods in the future. Ouch. So how do you protect yourself? Bonds, especially inflation-protected ones like TIPS, Treasury Inflation-Protected Securities. These aren't exciting, but they're like insurance for your portfolio. When inflation rises, TIPS adjust so your real return stays stable. Even a modest allocation, say 10–15% of your portfolio, can act as a shock absorber. If stocks take a dive and inflation surges, your bonds hold value. That's why retirees lean on them, but honestly, even 25-year-olds should consider having some in their mix. Another inflation hedge? Commodities and real estate, which often rise with inflation. But bonds give you the peace of mind that some portion of your portfolio is quietly fighting back against rising prices. You don't need insider tips, you don't need a massive inheritance, and you definitely don't need luck. What you need are systems. Your portfolio should be like a tree, deeply rooted, weather-resistant, and still growing year after year. If you start applying even 2 or 3 of these strategies today, you're already ahead of 90% of people who still treat investing like a lottery ticket. I believe knowledge is the foundation of success. If this video helped you, like it, share it with someone who could benefit, and subscribe for more insights. Now, if you want to know about 10 golden rules of money that can change your life forever, then watch this video. I'll see you there.